Bill Gross joining us right now, the co-founder of PIMCO, and out today here with his latest investment outlook, a look at some of those yields, a look at the risk of holding on to stocks and the differential, I guess, in the premium that, as we just said, Bill, doesn't seem to exist anymore. If that risk premium isn't there, Bill, I am curious as to exactly what equity investors would have to hang their hat on to justify entering into this market.
Well, I think, Romaine, they would have a hat to hang on, perhaps AI and the potential increase across the economy in terms of productivity. As of now, we don't really know what that is. As well, they would hang their hat on a stronger economy that may continue to persist as opposed to a recession that many are expecting. That's what they would hang their hat on. I would go the other way and take the hat off.
Take the hat off. And I mean, we know in the past from speaking to you as well as some of your other public statements that you took that hat off a while ago here. I mean, what hat are you wearing right now?
Well, let me explain it this way. I think PE ratios are coming down. Katie explained it in terms of an equity risk premium being close to, basically the bond market, and meaning that there's little risk in terms of stocks relative to Treasury bills or short-term Treasury notes. I would put it this way. Give me 30 seconds for an example that. A PE ratio at 20, turn it upside down as an EP ratio at 5, so an earnings ratio at 5. A PE ratio of 20 was a year and a half ago, and since then, real yields, as Katie pointed out, have gone up by a good 350 basis points. If, and I'm not saying this is going to happen, but if the earnings yield ratio, the EP ratio, went up from 5 to 8.5%, then PE ratios would be down around 12 or 13. Now that's a little old school. That's Gordon discount, dividend discount model type of thing, but it does indicate the direction in terms of PE ratios that they might move if we see a situation of real yields still at 2.40%.
And let's break down what we've seen in terms of nominal yields. As you mentioned, real yields very high, and they've been in the driver's seat, really, if you think about this rise in the 10-year yield. Talk to us, though, about break-evens. Do you think that inflation expectations should be higher here, given what we're seeing in the energy market?
Yeah, I think it should. And, the break-even rate for the 10-year, amazingly, is rather stable between 2 and 2.3% today, I think around 2.34%. And so that's the expectation for inflation. I would say it's more like 3. Getting down to 2 is going to be very difficult going forward. And so, that to me means that nominal treasuries, take the 10-year again, at 4.75 or 4.8, that nominal treasuries are basically based upon an expectation for a 3% Fed funds rate over a long-term basis. There is a equity risk premium that you talked about. There is a term premium for bonds as well of about 1 to 1.25%, because that's the risk of owning a 10-year versus a Treasury bill. And so if Fed funds settle around 3 to 3.5%, a 5% 10-year Treasury is decent value. It's not great value.
What is great value, though? When you think about 5% on a 10-year Treasury, we haven't seen that for 15 years plus. If that's not great, what is great?
Well, it's greater. There's no doubt about that. But 5%, again, would be a normal bond term premium of about 1.25% under 3% inflationary expectations. So that's okay. And I know corporate spreads have widened out a little bit, and that makes them attractive. But what I think has happened, Katie, in the past several weeks, and the market is beginning to recognize Treasury supply, based upon a $2 trillion deficit. They're beginning to recognize, basically the selling of bonds by the Fed in terms of the QT. They're beginning to recognize higher for longer as well. And so those two factors have been important in terms of the current rise. What I've seen in the last week is that the bond vigilantes, to the extent that they are now individuals owning, billions and billions, hundreds of billions of bond ETFs, they've been spooked over the last week or so by declines of 2, 3, 4, 5% in their ETFs. And so I think they're joining the crowd in terms of selling, and we're seeing a little bit of an oversold market here headed to 5%.
Certainly oversold, but I do worry, Bills, about some of these external events. Of course, yesterday there was a lot of hoopla around basically the Speaker of the House losing his position here, and whether this was symptomatic of just the dysfunction in Washington. You mentioned the federal debt. We know debt servicing costs have gone up from sub 2% here for the government to, I think, now somewhere in the 4 to 5% range here on average. How much of that ends up becoming a factor in investment decisions, or can you ignore it?
Well, I don't think you can ignore it. We're going to see the point again 30 days from now in which they have to vote, and we'll have a new speaker, I assume. But to me, it indicates, disruption in terms of the process, additional disruption based upon what we've seen, because 10 conservative Republicans basically are running the show in the House. And so that will increase volatility in terms of all markets, and certainly is a negative.
Well, yes, we can blame those 10 Republicans, but there really hasn't been a major player, at least when it comes to, fiscal conservatism for quite some time, at least not one that is listened to. And I'm talking on both sides of the aisle here. So this isn't just a party issue here. It just seems that whatever appetite that we had to address the fiscal situation, at least for now, just seems to have completely dissipated.
Well, yeah, the fiscal situation is very much of a negative. I mentioned $2 trillion in terms of a deficit, at least for this particular fiscal year. And the incredible thing, you've pointed out in the past, that the higher level of interest that the Treasury must pay is going to add increasingly to this deficit going forward. And so we don't have much to hope for in terms of deficit spending. If anything, you would think that the fiscal side would come in and start spending money if we have a recession or a significant slowdown. So deficits, as far as the eye can see, is what I can see, and that puts obvious supply pressure going forward, probably twice as much as what we've had over the past year or two in terms of Treasury supply. So,
well, it makes me wonder then, Bill.
We're going to have to see what happens.
Yeah, well, it makes me wonder, Bill, about the whole ideology of bond vigilantes. Is that something that even really exists in this current environment? Is there someone or some group of people that have that much sway still in the market?
No, there isn't, Romaine, and I use the term loosely because back in the day, the vigilantes that Ed Yardeni talked about were in control to some extent. These days, to speak about an ETF holding by an individual as representing a bond vigilante is a little loose, a little bit of a stretch, as I suggested. But what I've seen in the past week or two are significant sales of ETFs. The volume on AGG or the volume on BND, which are $100 billion ETFs, has been significant. And so what I see are these smaller vigilantes joining the Treasury, joining the Fed in terms of negative pressure for bond prices and higher pressure for bond yields.
Well, just to ask sort of a simple scene-setting question, if it's not vigilantes, what do you think is driving this move at the long end? Do you think about 80, 90, 100 basis points move higher in 10-year Treasury yields over the past couple months? What's driving that, and what's going to bring it lower?
Yeah, I think so. That's important, and we talk about a forecast for a 10-year Treasury, but we should also talk about the shape of the yield curve. And as you mentioned, longer yields are headed higher, shorter yields not so much, and we have a less negative yield curve, which I think is important going forward in terms of markets. So what's driving it? I think to some extent the sales of ETFs, which own long duration as opposed to short duration, is important. I think the mix of Treasury sales is important going forward. Next week we'll see a 3, a 10, and a 30-year combined offering of perhaps $100 billion. And so the long end is being pressured based upon supply and based upon expectations for a stronger economy than what was the expectation 3 to 6 months ago.
Bill, you tweeted yesterday, 30-year mortgage at 7.7%. This shuts down the housing market. And to that point, Bill, it feels like everyone is unhappy here. You have sellers struggling to sell, and buyers don't necessarily want to buy in this market either.
Well, I think that's true. That speaks to the secondary market. What I was suggesting as well is the new housing market, construction, new housing starts, and so on. And it's hard to see, despite the relative success, I guess, of home builder stocks in the past several months. It's hard to see how new homes can be sold with a 7.7% mortgage and maybe some points added onto that. So, typically housing, Katie, leads the economy by 6 months or so, and so what we've seen is a relatively robust housing market, but at 7.7%, that doubles and in some cases triples the payments, the home payments that a homeowner would have expected, perhaps a year and a half ago.
Yeah, absolutely, Bill. And I am curious, though, too, if we talk about the secondary market, and our apologies to our viewers if you hear the phones, there's a national test going on here that's going across the newsroom and beyond. So no worries there, Bill. You weren't the only one with the phone on. I am curious, when we look at spreads, I mean, you mentioned earlier about corporate spreads, but I was taking a look at MBS spreads as well, and they've really sort of widened out to, I think, probably some of the cheapest levels that we've seen, at least since the big housing bubble collapse a few years back here. I'm curious if what we can extrapolate about that here. If you have that tightness in the housing market and nobody's making money in MBS here, what's the equal sign and what comes after that?
Well, I think you're correct. I mean, the spread between a 30-year mortgage, and there's an index on your Bloomberg screen that will point that out at 7.7% or so, but that spread relative to a 10-year government is significantly wide. To me, what that portends going forward, if that spread narrows, is that it's very much of a benefit to mortgage REITs, such as Annaly's, such as AGNC, that yield about 16%. Now, this particular sector thrives on a less negative yield curve, and it thrives, basically on lower market volatility in terms of the Treasury market, both of which, hopefully we're going to see going forward. So is a 16% yield on a mortgage REIT a safe yield? Not necessarily. They've been cut before if these mortgage REITs, have been over-levered. But I think they learned their lesson. I think we can move into this sector, and capture the yields as well as perhaps a 10% price appreciation if the mortgage spread narrows.
And Bill, I do want to switch gears here in the couple minutes we have left with you and ask about something that you had in your investment outlook. You wrote that some of the best bets right now are arbitrages in merger and acquisition deals. You specifically named Microsoft buying Activision Blizzard. I'm curious whether you view that as idiosyncratic to that specific deal, or are merger arbs in general more attractive right now?
Well, they've become more attractive in the last week or two as liquidity in both markets, in the stock market and the the bond market has declined, and in some cases, as I was explaining to my wife last night at dinner, margin is required to to maintain those positions. So, ATVI Activision, to my way of thinking, it's 7 days away from approval by the UK Regulatory Commission. That means the price goes from 94 to 95. That's a point. That's 1.1%. Is that a big deal? It is over 7 days. And so, there are other examples such as Capri, which owns Jimmy Choo's, and other lines that are being acquired by a private investor, and that's selling at a discount of 10, 11, 12%. So there are situations, not a lot of them, but situations in which arbitrage can produce returns, certainly much higher than what we've seen in the equity market over the past few months.
All right, Bill, going to have to leave it there. Great to catch up with you. Bill Gross there, he's the co-founder of PIMCO out there in California with his latest investment outlook.